Um, see, as planned, let us get into Ind AS 37, the quick revision of Ind AS 37 as well as the MCQs of 37. We will try to clear it off. Okay, yeah. So, right, Ind AS 37, as you know, it talks about provisions, contingent liability, and contingent assets. So the important and the major part is nothing but important, right? Major part is nothing but provisions. Okay, let's have a look at first provision. What is a provision? Provision is a liability of what? Liability of uncertain amount or uncertain timing. Correct. Liability is a present obligation arising from the past events. Correct. No, on settlement of which expected future economic benefits outflow from the entity. So there should be some obligation at the present. Present means what is that? That is on the balance sheet date. Correct. Obligation, yes, it's a duty, responsibility. It arises from where? It arises from basically from a contract. It may be, I mean to say, it's a contractual obligation, or it may be a legal obligation. It may be a constructive obligation, which is arising from the promises made by the people, and it's maybe because of the business practices which they are following so far. That's why this obligation has come directly or indirectly. Right. To make a provision, there are obviously three conditions are there. If you satisfy all the three conditions, companies must make a provision for the said thing. What are the three things? The first one is present obligation arising from the past events. Probable future economic benefits outflow. Next, the third one is what? Reliable estimation should be made. It should be, reliably measured, basically. Yeah. So these are the three conditions. I repeat once again: present obligation arising from the past event, probable future economic benefits outflow, and reliably it can be estimated. Correct. So a provision for depreciation, no, it's not a provision. Okay, right. It is a reduction of an asset. Provision for doubtful debts, it is not a provision. It is reduction of asset again. Correct. Na? Because provision is a liability. Liability leads to outflow of money. Yeah, it's not, it is reduction of inflow of money but not outflow of money. That's why it is not supposed to be a provision, right? Anyhow, once you say this is a provision, what are provisions, what are not provisions, I have given very clearly. Right, sir, how do we make a provision? Provision should be based on the best estimation available at the time of preparation of financial statements. First, it should be, obligation should be there as on 31st March. Estimation purpose, you can use even events occurring after the balance sheet date also supposed to be considered. Okay, yeah, till the date the financial statements are prepared by the board of directors, board of directors signature. Correct. Now, whatever the reliable estimations, if they get the best estimation after 31st March, that information is supposed to be taken care. There are two methods for estimation. Yeah, these are the, these are the methods even if you find it in Ind AS 115 as well. Okay, so what are these methods? First one is called expected value method, which is nothing but weighted average of all the probabilities that is expected to occur. And the next one is single most likely outcome. Yeah, see, first one is what? Expected out, what is that? Expected value means present, that is the probability of all the weighted average of all the possibilities will take into account. Single most likely outcome means, yes, it may be, the answer is either yes or no. Got it? Yeah, under that circumstance, whether it is yes or no, are you going to win the case? Yes or no should be answer. Correct. Now, under that circumstance, what is most probable? Correct. Now, more than 50%, if you say I'm going to win the case, then I'll not make a provision. I may go with contingent liability. If you say most probably I may lose, there's 60% chance to lose the case, then you are supposed to make a provision for that case. Okay, yes, exactly. So next, review the provision. Correct. Obviously, you are supposed to review the provision on every balance sheet date, right? Maybe last year you made a provision, now current year it not required, then you, write back. Yeah, sir, last year I made a provision, sir, but amount may be increased, amount should be decreased. Yes, you can do the adjustment. That is what. So that's why the standard says the provision should be reviewed on the balance sheet date. Next, sir, is the provision should be discounted? Yes, every provision is supposed to be discounted for. Yeah, in accounting standard 29, there is the provision should be discounted for only with respect to the provision which is directly related to property, plant and equipment. But here there is no such concept. Every provision is supposed to be discounted. But at the same time, correct na? At the same time, what is that I am trying to say? If it's the provision which is going to be settled within 1 year, then you don't need to make a provision. It is obviously because the impact of what impact of the present value is going to be a small number. That's why we are not going to make a discounting. If it is more than 1 year, obviously we expect that it is supposed to be discounted for. Okay, done. So next point is what, sir? Whether provision is supposed to be okay. Sir, provision is supposed to be, will be credited all the time, right? What do you debit it? Shall I debit the profit and loss, or shall I debit the property, plant and equipment? I mean any asset. Yeah, the question is very simple, right? What is the supposed to be debited? Debit is, first of all, when you are making a provision, question is it directly related to property, plant and equipment, or is it directly related to an asset? Like it may be an intangible asset, it may be an investment property, right? If it is yes, then it is supposed to be capitalized with the respective asset. No, sir, it is not related to any of these three things. Then it is supposed to be charged to P&L. Say example, warranty expenses. Warranty expenses, your warranty provision you are making because you have a, what is that, I mean you sold the goods basically, correct na? Yes. So that information, what are we supposed to do? Yeah, that is supposed to be, this is not related to a property, plant and equipment, so it should be charged to P&L. So warranty expense account, debit to provision for warranty, that is what supposed to happen. Next. So, okay, done. So next, if there is a change in the provision amount, what will happen? Yeah, now when there is a change is in what basically? Change is in what, in the sense, change is because of the, I mean amount change, or estimation timing change. If the amount is changed, I mean say I thought 1 lakh rupees will be spent, that is sufficient, I thought it, but no, subsequently I realized 1 lakh 20,000 is supposed to be spent. Then if it is 1 lakh 20,000 means 20,000 either increasing, decreasing, whatever it is. If it is amount change, first one question should be asked. Initially when you made a provision, what have you done? Sir, I charge it as a warranty expenditure, or I have capitalized with the property, plant and equipment. Something example. I mean either you charge it to P&L or whether you add it to the asset. Same thing you are supposed to do even when there is a subsequent change in the provision amount. Okay, so known as a timing is changed. Timing is changed, it means I thought I will be spending in 4 years at the end of the fourth year. No, but it happened at the end of the fifth year. Correct. So timing issue has come, then that is supposed to be correct. Now that should be charged to finance cost. Yeah, as you know, when provision is discounted down, correct. Now obviously you are supposed to you are supposed to apply the, I mean unwinding the provision. Unwinding the provision will happen always interest cost, that is finance cost account debit to provision. So this is the present value impact. If the timing is changing, that means present value impact. So it is supposed to be charged to finance cost only. It is supposed to be charged, right? So that is the major points about provision. Let's look at the contingent liability issue. Contingent liability is obviously, it's not a, I mean there are two definitions. One is what probable, one is what a possible obligation arising from the past events. Okay, right. The estimation, I mean what is that? The existence of which is confirmed by occurrence or non-occurrence of one or more future events which are not under the control of the entity. Exactly. So which is not under the control entity, currently it's a possible obligation. It may happen, may not happen. It is depending upon some other event or circumstances. So if it is a contingent liability, then it is obviously we don't treat the journal entry. I mean no recognition will take place, only disclosure in the financial statements is going to take place. Agree, right? There is one more definition for this. There is a present obligation. So it's like a similar to provision judgment. I mean provision ka definition it is given. Present obligation arising from the past events, but we could not make a provision. Why? Because it may be not probable. Okay, yeah, we feel we are liable, but I'm not expecting an outflow of economic benefits, or I'm not able to measure the outflow reliably. Because of these two reasons or any one of the reasons, I'm not able to make a provision. Okay, if you are not able to make a provision, at least present it to the people. What is that you are going to present? Say under the contingent liability, give the information. That is what you are supposed to do it. Okay. Yeah. Next one is contingent asset. So what do you mean by contingent asset? Yes, contingent asset is also again possible asset arising from the past events. Expect correct, I mean existence of which is going to be confirmed or confirmed by occurrence or non-occurrence of one or more future events which are not under the control of the entity. It is a possible asset. So since it is a possible asset, we are not going to recognize the asset. Okay, then what? So then first you have to ask one question. Yeah, what is the what about the outcome? What is that your expectation of outcome? Yeah, see, if contingent, um if there is, if it is a contingent asset, sir, I am say it's possible. If you say, if it is possible asset, no, then you don't disclose it, you don't write any journal entry for asset also. So it is probable, sir. If it is probable, yes, you can disclose it in the notes to financial statements. Sir, it is virtually certain, pakka I am going to get back this, then no problem, my dear, you please take it. Correct, now you take it as, once it is virtually certain, then why contingent asset? It is supposed to be an asset. That's all. So the next concept is reimbursement, reimbursement of expenses. Reimbursement of expenses means I spent money on behalf of you. Correct, na? No, no agreement is written between you. Correct, na? We have not spoken about it, but we have spent some. I have spent some money on behalf of the company. Whether I will get it or not, that I don't know. Correct, na? Right. So end of the day, if I come to you and say, hey boss, you are supposed to pay me, when did I say this, sir? Karke, you will tell that. Correct, na? So that's why the standard is says, if you have incurred some expenses on behalf of any some person, it is supposed to be recognized as an asset only when there is a virtual certainty. Yeah, these two, contingent asset related and this one is, this is an exception to asset definition. In case of asset conditions, the probable future economic benefits are sufficient, but with respect to contingent asset, with respect to reimbursement expense asset, correct now, no, that is not just probable future economic benefits are not sufficient. Virtual certainty is something is expected. These two are exception to the basic definition of asset and conditions of an asset. So here, if it is virtually certain that you are going to get back the money, please recognize the asset. Otherwise, don't record till you get confirmation from the other party. Otherwise, you're not supposed to record it. Right. Next concept is onerous contract. What is onerous contract? Onerous contracts are something unavoidable costs. Okay, unavoidable costs which are obviously going to leading to a loss to the entity. When the loss is, I mean, see this, whenever I speak this, no, don't think that this is not a, I mean, normal contract. This is like a binding contract. So if there is a binding contract, then only you are supposed to look at this onerous contracts. Yes, you have to, suppose your real estate company is there. Yes. So they have to construct the building because you already signed. The job is that you have to construct the building and go. If you leave this place, no, you have to pay me huge amount of penalty. Okay. So then what is that generally you should make a provision? Sir, if I continue and complete the building, what is the loss I am expecting? If I close this contract and if I'm ready to pay the penalty, what is that loss I am going to pay? Obviously, anybody's choice is going to be whichever is lower. That's what we say. Cost of fulfilling the contract means that is a loss basically. Compensation or penalties if you cancel it. That is the second line item. Whichever is lower, you are supposed to make a, I mean, provision for the same thing. Restructuring provisions, yes, restructuring is a program which is planned by controlled by the management, which is going to materially change the scope of business and the manner in which it was conducted earlier. Okay, yeah, here also generally people will think like too much. Don't think too much, my dear. Whether it is restructuring provision or whether it is a warranty provision, whether it is a provision for restoration of a fixed asset, it is same. The same three conditions, that is present obligation arising from the past event, probable future economic benefits outflow, and it should be measured reliably. These three conditions are supposed to be satisfied. If it is satisfied, then make a provision. And again, remember, in case of restructuring provisions, most of the circumstances, these provisions are constructive in nature. It is not legal, it's not contractual. These are constructive. The minute we make a promise to the public, which is, I mean, we took a judgment in the board of directors meeting, and when we went to the public and we have intimated them, then obviously it is supposed to be a constructive obligation. Still, you can say I can come back, but no businessman will come back because at the cost of goodwill. If you say some sentence and if you come back, no, then what will happen? People will not believe you next time. That means you lost your goodwill. So nobody will take the risk of their goodwill. Okay, so this is the 15 minutes of, I think I tried to explain it in 15 minutes, the entire concept of, right. So, chalo my dear, let's get into India's 37 MCQs. These are not too many. Okay, I think we'll be able, probably some 45 minutes, I'll be able to, let's see, whatever it is. See, proper completion is important. Yeah, so in ICI material, there were not a huge number of questions, my dear. Only some 4-5 questions were there. Rest all some other questions we have added. Okay, so which of the following represents an appropriate discounting rate? Yeah, for measuring the provision based on the India's 37 and the contingent, I mean 37. Yes. blur. One second. Is it clear now? No, is it? Okay. Give me a few minutes. Give me a minute. Check this out. Is it still blur or is it okay? Just a second. Okay. Which one of the following represents the appropriate discounting rate? The question is what? Yes, we said that every provision is supposed to be discounted. For which rate are you supposed to take? Very good question. Correct, na? Right. So what is the thing, my dear? A market yield on the national government bond. See, market yield, I mean, yield on the government bonds very clearly said in Ind AS 19, that is employee benefits. But here, that is not the sentence they have used. Okay, next. Market yield on the high quality corporate bonds. No, that is also not the one. Before tax, the current market assessment of the time value of money and the risk specific to the liability. This is the exact terminology. This is pre-tax. Yes, before tax. Yeah, just compare this next two sentences, my dear. Correct na? Market assessment of value of money and the risk specific to the entity. Risk specific to the entity, no, my dear. Risk specific to the liability is what the risk specific to the liability. Okay, that is the sentence very clearly used in the standard. Correct? We have noted already when we were discussing. Which is specific to the liability. It is not talking about the right, what is that credit worthiness of the entire entity. No, whether are we going to settle this or not. I may be having a lot of money, but I may not be. I don't want to be spending this settling the this specific liability. That you are supposed to keep it in mind. Okay, C is obviously without any doubt discussion right answer. Right, second question pado yaar. What is the what which one of the following is correct statement in relation to provision and contingencies? Yes, my dear. I am sharing it in the group right now. Don't know what is happening. Can I send it here directly? I think, is it possible? I think here I can't attach, no? Yeah, just a second. Now it started working. Yeah, shared it. Just take a look at it. Yes, tell me, my dear, which one of the following is a correct statement in relation to provisions and contingencies? Okay, tell me, an item of contingent nature may be recognized, contingent item recognized but not disclosed in the body of the financial statement. If it is a contingent liability, do you recognize it? Then obviously it is wrong. We disclose it. Yeah. In days 37, provision contingent liability contingent applies to, correct na? Yes, applies to what, my dear? It is going to applies to a provisions. It applies to provision to perform land rehabilitation activity. Is it only provision for land rehabilitation? Not related to land rehabilitation activity. Provision related to, I mean, rehabilitation also will be recognized. But this is not the objective of the 37. Okay, next. This is applies to a contingent liability, contingent assets of the insurers. No, insurer contracts are separately dealt, not by here. Present obligation exists in all circumstances where a company may have some choice of whether or not to make a future sacrifice of the economic benefits in a settlement of an obligation. Yes, my dear. So tell me, what is your answer? Right? See, this is correct. Now, whether or not you will have, this is also not correct. That is, no, no, it's not correct, my dear. Just look at the sentence once again. A present obligation exists in all the circumstances where a company may have some choice. Where is the choice, my dear? It is an obligation. Obligation is a responsibility. Correct. Now, obligation is a responsibility. You have to do it. You don't have a choice. Correct. Now, all the time, whenever I discuss the word provision, present obligation, correct. Now, I always say this is not a choice. This is not a right to you. This is mandatory to you. Correct. Now, yes. So, in the given circumstance, at least this is the better answer. What is the better answer? This is the B. Does it deal with the performing land activity need that you're supposed to write it as like provision for what? Provision for rehabilitation. Yes, provision for rehabilitation is dealt by the standard. Yes, without doubt, provision for rehabilitation, provision for restoration, provision for decommissioning, all these provisions are dealt by my standard. That is better than the other three sentences. So, okay, at least nearby. That's why I'll vote for B rather than the other three items. Okay, I think Chetan is clear. Yeah, Nathan also done. Yeah. So now look at the third bit. What is third bit here? As per Ind AS 37, provisions contingent liability and contingent assets where measurement uncertainty exists. Correct. Which one of the following methods is not an appropriate valuation for the provision based on the accounting standards? Whatever accounting standards are in AS. Yes, my dear. Answer the question. Mid, right. They are asking estimation methods. I mean, estimation method, what is the estimation method? The midpoint of the range of equally likely outcome of the expenditure. No provision should be recognized where measurement is uncertain exist. The minimum amount of expected represent a best estimation where the other option is an omission. The most likely and expected to represent the best estimate where there is a single obligation. Yes. So answer me, my dear. D. Hmm? Yeah, see, as per Ind AS 37, the question again, once again, I'll read. Which one of the following method is not an appropriate method? Not an appropriate. Read again. Yeah, which is not correct. for making the provision. See, debit is perfectly all right. I mean, it's a correct method. It's not correct method. I hope you understood. So, and since they're asking which is not appropriate, that's why it is not that. I mean, you are not supposed to select this one. Next thing, tell me minimum amount expected to represent the best estimation. Where the other options are, other option is an omission. I mean, other option is not applicable. We'll apply the best estimation in the given circumstance. Yes, this is also correct method. So that's why correct method is not what they are asking. No, that's why you should not go with that. The midpoint of range of equally likely outcome of the expenditure. Okay, I mean say equally likely outcome expenditure in the sense what? That is midpoint in the sense nothing but weighted average. When I say equally outcome means what? This is happening chance of 20 percentage. This also happening 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 20%. Means point to point to point is the probability. When the weightage is equal to same, then what do you do? Obviously, the what is this? What are you supposed to do? Yeah, all these four amounts. Amount also must be there no next to that. Then we will take a weighted average. When the weight is same, simple average also will work, not weighted average. Under that circumstance, simple average is equal to weighted average as well. So this is also correct in that angle. So that's why right. So next, a provision should be recognized. Um, should be recognized where the measurement uncertainty exists. A provision should be recognized when the measurement uncertainty. No, if it is measurement is uncertain, provision should be made. What else you should do? Answer. We discussed just now under the definition of contingent liability. Under the contingent liabilities, that is the second definition. Exactly, my dear. You people answered excellently. Correct. So under contingent liability, second definition may where there is a present obligation arising from the past event, but I am not able to make a provision. I'm not able to make a provision. You should not make a provision. You should go with the contingent liability when there is a probable outflow is not there, when the measurement is going to be uncertain. I'm not able to measure also. Yes, but he is saying the provision should be made. No, my dear, provision should not be made in this case. It is supposed to be a contingent liability that is supposed to be done. Correct, na? So which is wrong. That's why this the wrong is only correct. He is asking. Correct. Which is wrong? He is asking. That only I gave you the one. Right. Chalo. Let's go with the fourth bit. What is the fourth bit, my dear? As of 31st March 2021, reporting date, whatever, ABC Limited is involved in a legal dispute with one of its supplier in relation to early termination of the exclusive license agreement between the two companies. Okay, they got into. Yes, Nathan, yeah, doubt. Otherwise, let me read this full paragraph, then I'll come back to you. Yeah, the supplier seeks damages. The supplier seeks damages of 50 crore rupees. The directors of ABC company believes that they will be successfully defending this claim. ABC lawyer have advised that there is 90% chance that the entity would not be making any liability for this claim. So he's saying, I mean, it is certain kind almost. In accordance with the Ind AS 37, okay, contingent liability and our standard name. Okay, which one of the following is the most appropriate option for the ABC while preparing the financial statements for 31st March? Okay, see, somebody claimed on me that 50 crore rupees you are supposed to pay. Mylar is saying 90% we are going to win. We are going to defend the situation. We will not be paying this number. So he's very confident, highly confident about the situation. Yeah. So tell me, my dear, shall I make a provision or shall I give the contingent liability disclosure? What is that your answer? Contingent liability? Yes. Fine. So what is your answer, my dear? Neither recognition of provision nor disclosure of the contingent liability is required. See, there is actually EBIT also is most probably correct actually. Why? Reason 90% when there is a chance that we are not going to make a payment, that means isn't it a remote condition, my dear? At least you should have made it. You should have made it what? It is 80% they should have made the in the question. If you say it is a remote condition, no. If it is remote condition, 10 or below 10 basically. If it is 10 or below condition, you don't need to disclose the contingent liability, you don't need to disclose the both, actually speaking. Yes, my dear. So let's continue the discussion here. See, since they have that is a small mistake, I feel, or the confusion thing actually they have made it. See, below 10 percentage is called generally below 10 percentage is called 10 below 10 percentage is called remote. Under in case of remote circumstance, you don't need to do anything. I mean, you don't need to neither to disclose not to contingent liability. This is the basic thing which we speak. Right. Or the next point is what if you say exactly 10 percentage, this is to confuse you. But you make a note and you, I mean, whenever such kind of thing information is given, no, exactly 10 percentage, 10 percentage chance. Below 10 percentage, you say below 10 percentage is remote. Like that, you make a note yourself and you follow this whenever in the MCQ, whenever they discuss below 10 percentage. So if it is 10 percentage exactly, then you go with the contingent liability option. So considering this information, now whatever you told, contingent liability, that is contingent liability disclosure is correct. Obviously, making a provision does not make any sense in the given circumstance. Done? Yes. So let's go look at the fifth one. Right. Yeah. Sorry. Before going to fifth one, yeah. Nathan, yeah, yes, you had some question. Can you please? You can unmute yourself and speak. Yes, yes, please. B option is also correct, you are saying. Okay. No, B option we told correct. We told B option only correct, not the D option. No, there's a disturbance in voice. Its B option is correct, my dear, not the other option. Right. Chalo, let's go to the next question. Which of the following drives a constructive obligation? Constructive obligation under Ind AS 37. Tell me, my dear, which of the following drives? Yeah, established pattern of past practices, a specific current statement. You made a statement, you said like we are going to satisfy this, that is the situation, or a published policies, or all of the above. Yes, you people rightly told all of the above. Yes, even the published practices, whatever the statement made by the company, or the pattern of the past practices, yes, that also gives, I mean, that will make the other party to believe that we are going to satisfy this. So it binds us indirectly. That's why it is a constructive obligation. Okay, let's look at the sixth bit. SS Limited, C Limited are the joint ventures in AS Limited. Okay, joint venture, joint venturers. These are the venturers. Joint venture is AS Limited. And sharing a joint control equally, done 50-50. SS Limited and C Limited. Actually, this jointly controlled, when I speak, no, today only I submitted one opinion. Yeah, that was, what is the opinion? No, today one opinion, yesterday one opinion I gave it. One, this opinion is with respect to, I mean, whether it is a jointly controlled entity or a controlled entity. Jointly controlled entity or controlled entity is the question. Okay, yeah, I'll explain you. It is relevant to you, obviously. Nothing is out of syllabus. These are all part and parcel of our correct na syllabus only. Yeah, I'll explain you. Yes, hope you are interested. Right. See, there is a company A, there is a company B. These two companies have opened a new company called C. Okay, here there is a 51 percentage is the stake, and here say some 49 percentage is the stake. This company will appoint two members as the board, and here also two members as the board. And this side only MD is going to, I'm sorry, not MD, chairman. Chairman of the meeting, board meeting is going to be, I mean, out of these two members only, anyone should become chairman. That is mandatory as per the agreement. Out of this chairman will be having a casting vote. Casting vote in the sense, correct na? There are totally four people. Two people said yes, we like this. Two people said we don't like this. Now it is tied, right? So, correct na? I did tie. He tied tie breaking is what casting vote. So then additional vote will be given to chairman. So then obviously this side people, this side will be voting for three. Then obviously there whatever these people will say end of the day that will work. But in the joint venture arrangement, what they told, they wrote some 30 items. They wrote, what is that 30 items? These are like reserved matters. Reserved matters in the sense, with respect to these matters, no, your casting vote will not work. Your chairman vote, nothing will work. Here mandatorily 100%, that is unanimous consent is required. What is it? Unanimous consent is required. Got it? Right. But now what are you supposed to do? We have observed, correct? Now we have seen all these 30 items. Kya? These 30 items are, like, is it related to day-to-day business activities, or is it like something different activities? Or is it like a protecting kind of thing? Correct? Now, isn't it protective in nature, or is it participating in nature? See, whatever he told, in that out of 30, just simple examples I'll tell. See, without my permission, you should not give the dividend. It's okay. Dividend giving is not a financing decision. It is not like day-to-day operating decision. Correct. Now, whether you give dividend, do not give dividend, what will happen? That will not impact my current year profit. No, it is not linked to profit. Yeah, you cannot increase number of directors. That's okay. You cannot borrow me. I mean, above this limit. You can purchase capital assets and capital investment, you can do it. But if it is crossing too much, say 25 crore rupees of capital budgeting, capital assets you want to purchase, then you need to take my permission. Such kind of things are given. So those are like what B is trying to say. B is, these are all supporting B, but it is like a protecting in nature. Correct na? See, by doing your activities, I should not be cheated. That's all is they are trying to do. So since it is a protective in nature, kya bola? This is protective in nature. We said we have a casting vote, we have a chairman of the meeting, correct na? Yeah, I mean they will decide that the chairman has the power what to decide and decide in the discussion and etc etc. At the same time, casting vote also is there. But these are not going to impact the day-to-day operation. These are not going to impact the profits of the entity. So profit of the entity is totally controlled by in the sense the operations are controlled by A alone. That's why we said A has got control rather than it is not a joint venture arrangement. So don't go by the word just because joint venture arrangement wording is given. You are not supposed to conclude it. Okay, JV control F JV so it is no. Okay, one more opinion is expressed yesterday is with respect to is it a CCBC or not, common control business combination or not. Yeah, it was a common control business operation, one of the big six I should say. Okay, yeah, I mean top firms, already there were four acquisition of same sort. They have accounted as a business combination. They have accounted as a business combination, which was seriously shocking to me. Fine, but that was actually a CCBC, common control business combination, which is supposed to be recognized at book values of assets and liabilities should be brought in, no goodwill, only capital reserve can be positive, negative. Correct? Na? So many things you are going to learn. If you have already started, yes, you must have got it. Chalo, let's go back to our original discussion. So SS Limited and S Limited, okay, there are two companies are there. Okay, this company, they have joined. There is a joint venture called AS Limited. Okay, and there is a 50-50 percentage stake here, 50% stake here, 50% stake here. Okay, jointly and severally liable to the rights and obligations in the joint venture. AS Limited and AS, correct? Na? Okay, fine. AS Limited has received a major claim of 10 lakh rupees for the goods sold to the controls customers of 2021-22. Okay, there's some customer has raised a point. Okay, what will be the implication? This event in the books of the both of the joint venturers. Okay, joint venturer. This is a joint venture arrangement. So AS Limited is a separate obligation. Correct na? Joint venturer case mein what will happen? I mean in the books of SS Limited, in the books of S Limited, what will be the impact? Major claim for the goods sold to its customers. Tell me what are the answers? How will it affect? Let's see. First to see the answers, you will get to know. Rupees 5 lakh will be booked in the venturers as a provision in their books. Okay. Next, 5 lakh will be disclosed as a contingent liability in their books. Okay. 5 lakh rupees will be recognized as a provision and 5 lakh rupees will be disclosed as a contingent liability in the both venturers books. Oh, super. Okay. 10 lakh rupees will be recognized by both the venturers in their books. Yeah. Answer me, my dear. What do you say? Hmm? Little funny question, basically. Okay, practically this none of this is going to come in. I mean, not in the examination. Examination. See, AS Limited has received the correct. Now, AS Limited has received the major claim. Right. No, as per me, none of these are correct answers. Yeah. Why it is not correct means I'll explain it to you. How the accounting will take place. Okay. First thing. So, is it a joint venture operation or controlled entity? Jointly controlled entity or joint operations? First thing you have to decide it. Correct, na? Yeah. So and again, whenever there is a separate legal entity concept, yes, AS Limited he told. Has he told limited? Correct, na? AS Limited he told. That means it's a company. Correct, na? It is AAS Limited is a company. In case if it is a company, first he has to mention that what he should mention. Is it a jointly controlled operation? Or what exactly is it? Why are you talking about that? If it is a jointly controlled operation, na, then the party A will recognize their share of asset and liability. Party B also will recognize their share of asset and liability. That's it. If it is a jointly controlled entity, no, then we will be following Ind AS 28. That is equity method we are going to follow. When I follow equity method, it's a separate entity. So AS Limited will book the provision for 10 lakh rupees, but it is not going to be booked by the venturers books directly. Venturer books directly. Okay, right. So they have not given very clearly. Agreed. That is obviously they have not given clearly. So if I go with this assumption, no, it is not a jointly controlled entity. Okay, joint arrangement is there, but it is not a separate. Yeah, it's question itself is wrong, I should say. So it is not a jointly controlled entity. If I close it, then I assume this, sir, it is a jointly controlled operation, sir. Yeah, if it is operation, what are you supposed to do? Right. Look at the lines now. 5 lakh rupees will be booked by venturers as a provision in their books. 5 lakh rupees will be disclosed as a contingent liability in their books. 5 lakh rupees will be recognized as a provision and 5 lakh rupees will be disclosed as a contingent liability in the books of the both the venturers. Yeah. So I should say mostly yes, CBT is more making sense in the sense, right? So as I told you, correct, na? Right. This is my activity, jointly controlled operation. I said. When I say jointly controlled operation, what is my liability? My liability out of 10 lakh liability, 50 percentage is my liability. 50 percentage is 5 lakh. Okay. Yes. Another 50 lakh rupees is the percentage. Done. Right. Liability, you record it because it is probable, highly probability. Sir, but fine, no. When I have recognized the 5 lakh rupees, what about the remaining 5 lakh rupees? This party is going to pay, na? Yeah, actually speaking, this party is going to pay. Understanding is like this. In the worst case scenario, suppose E party does not pay. A party becomes something, what is that, insolvent or such kind of thing. Okay, then automatically it will come to me. But that depends upon the settlement situation. If the other party is not able to pay, because we two are the controlling parties, so I will be having contingent liability also. That is the only reason it is supposed to be contingent liability, not only one sided. Hope you understood. This is linked with what, my dear? This is linked with Ind AS 111 and Ind AS 28. Good question, but they should have framed it. little carefully. Okay, fine, that's not a problem. At least they gave some idea. Fine, right. Next thing, the method specified in Ind 37 for estimation of provision in the financial statements include expected value method, which we spoke, midpoint of range of possible outcomes. This is also fine. That is a simple average method basically. Possible outcome mid average means average, basically weighted average, I should say. Okay, estimation of the individually most likely outcome. Yes, this is another circumstance. D, all of the above. Tell me, my dear. Obviously, all of the above, as you people also say. Correct. Eighth bit. What is eighth bit? Where the effect of the time value of money is material. Yes, yes. I told you, if the provision is for, if it's going to be settled within 1 year, impact of the time value of money is small. That's why we'll ignore it. We don't do the making discounting within the 1 year time. If it is able to expected to be settled after 12 months, then time value of is more better. That's why we will make a estimation. I mean, discounting will be done. Then come to the matter, where the effect of the time value of money is material, the amount of provision shall be, what? Shall be dash of the expected is present value of the expenditure expected to be material. Yes, you are supposed to bring it to present value, not fair value. Fair value is something is going to say paid, not market value, not this. Yes, B is the right answer. Perfectly set. So ninth bit. Yeah, SS Limited has made a correct na. SS Limited has made what, my dear? Yeah, yes. SS Limited has made a commitment to pay 16 lakh rupees at the end of the 4 years. At what value the provision is supposed to be required to be recognized? Okay, recognized in the books. Also, what will be the cost of borrowing in the year 3? See, year 3 calculation you are supposed to, you are supposed to do it. What are we supposed to, what are we supposed to do, my dear? Yeah, what provision do you make? 16 lakh rupees at the rate of 10 percentage, he told. Yeah, you're going to pay at the end of the 4th year. Yes, so what do you do then? Yeah, what are we supposed to? 1 divided by 1.1, 1, 2, 3, 4. Correct. Into 16 lakh rupees. There is going to be 10 lakh 92,000 rupees is 10 lakh 92. Yes. So now that is, what is it correct? B bit is correct, C bit is correct. But out of this, only one will be correct. Correct, na? Yeah. So tell me, my dear, 10 lakh 92,000 rupees. Third year interest is how much he's asking. Correct, na? Third year interest means first year interest on 10 lakh 92, what should I do? Plus 10 percentage, I will say. Some number has come. Next, plus 10 percentage, I said. Now, into 10 percentage, if I do, 1.32 is coming to me. Yes, 1.32. This is correct answer. This is wrong answer. Have you understood? You can do it in the calculator itself. Yeah. Are you able to do it? Yes. Simple. Basic calculator is more than sufficient. Done. So go to the 10th bit. Yeah. Where some or all of the expenditure required to settle a provision is expected to be reimbursed by another party, the reimbursement shall be treated. Should be treated as what? By offsetting with provision in the statement of profit and loss. Should be a separate asset in the balance sheet, disclosed in the notes to accounts as income in the statement of profit and loss. What are we supposed to do? Think. The reimbursement asset, this is. Yes, what's your answer? B. Yes, B is perfectly all right. That is 1 and 2. Yeah, B is 1 and 2. Yes, exactly. Why? By offsetting with the provision in the statement of profit and loss. Yes, in the statement of profit and loss, income and expenditure arising from this should be reduced. But in the balance sheet, a liability should be separately showed and then asset is supposed to be showed separately. This is what the concept we have learned. Agree? Yes. So This is correct. Disclosure, why? When you are saying like when you are when there is the where some are expenditure I mean when there is a virtual certainty, you will directly take it into balance sheet. Correct now, you will account it, recognition. Notes information can be given. That is a different concept. But that is not must or mandatory. These two are must and mandatory. That reimbursement shall be recognized when and only when it is reimbursement will be received if the entity settle the obligation. Tell me, my dear, 100% certain, virtually certain, reasonable, or none of the above. We discussed already. C bit, perfectly all right. Virtually certain. I told you this is an exception to the basic rule. Correctly said. Okay. What about the 12th bit? Alu Limited acquired a machine on a non-cancelable lease. Okay, for a lease period of 1 year. For the purpose of the contract A, contract for the purpose of a contract A for 5 lakh rupees. Fine, not a problem. The machine was very unique and could not be used in any of the contracts. Okay, specific machine. I mean, customized item must be. Contract A has cancelled because of some unforeseen situations, and therefore, to recover at least some part of the cost incurred, it sublet that machine for 3.5 lakh rupees. What is the amount of provision you are supposed to be recognized? See, it is a non-cancelable contract. But even the non-cancelable contract, you are liable to pay 5 lakh rupees. Correct. Now you entered into a subcontract which you discussed in the classroom also. Correct. Now 3.5 lakh rupees. 3.5 lakh rupees. Are you supposed to get the money? Yes, it is an income. So are you mandatorily going to lose an amount of 1.5 lakh rupees, my dear? Yes. He has not given me the penalty concept or not given. Assume 5 lakh rupees you have to mandatorily keep it with you. Then 1.5 lakh rupees. Correct now. 1.5 lakh rupees you are supposed to make a provision for. Have they given 1.5 lakh here? What is the amount of provision to be recognized? Yeah, 12th bit. Contract A was cancelled because some of the unforeseen situation. Therefore, to recover at least some part of the cost incurred in the sublet that machine to C Limited for 3.5 lakh rupees. What is the amount of provision to be recognized? Yeah, my dear, it is 1.5 lakh. This is not 15 lakh. There is one dot you are supposed to keep it. I'll change it when I share this. No, 1.5 lakh rupees you tick for C. 1.5 lakh provision C. 5 lakh rupees I have to make mandatory payment. And from the sublet, do I get 3.5 lakh rupees of money? Yes, I'm going to get 3.5 lakh rupees of money. So my amount, I mean, it's guaranteed loss. Then make a provision for 1.5 lakh rupees. My answer is correct. Just make a dot over there. That is a typing problem. Right. 13. Yeah. So 13. 13, what is that, my dear? The inventory of the C Limited amounting to INR 50 lakh rupees was destroyed due to fire in its premises. Okay. It filed a claim with the insurance company. It believed that it will be possibly receiving 90% of the amount claimed. Possibly receive. Okay, right. How will this event be recognized in the books of account? Contingent asset, will you say? Will be recognized. One recognition, first of all. Possible receive. Possibly receive 90% of the amount. Possibility is there. Possibility hai to I told you with respect to contingent asset, neither disclosure nor recognition. Okay, only when it is probable, disclosure. When it is virtually certain, then it is going to be recognized. Here it is not virtually certain even. Correct na? It is possibly. So what do you do, my dear? D. Possibly receive, actually as per the standard. The word, no, question itself is wrong, my dear. Just read the line once again. Once again read it. Hmm? I told you possibly receive 90% of the amount. When you say possibly word, na, your D is correct. Okay, D is correct only when it is probably. Change this to probably, then D is correct. Why are you changing? Why are you changing in the sense? Otherwise, you have to keep one more E, none of the above. When there is a possible outcome, when there is a possible of receipt, you are not supposed to recognize or you are not supposed to disclose it. Only when it is probable, you are supposed to disclose it. Only when there is virtual certainty, only when there is a virtual certainty. Correct, na? Yeah. Do one thing, small correction here. I am explaining. Okay, you please change it to possibly place में probably कर दो. Then yes, you record 90 percentage. 45 lakh will be disclosed. Disclosed. Only disclosure. Is that clear? Yes, someone else. Yeah, Nathan. Yeah. Yes. Now, according to Ind AS 37, a detailed formal plan for the restructuring shall identify. What should be identified? Business or part of the business concern, principal locations affected, expenditure that will be undertaken. Yes, any one of the above. Tell me, my dear. If you are, I mean, restructuring. If there is a restructuring in provision, what are you supposed to do with? Hmm? Actually, all of the above. Any one of the above also you can say. All of the above also you can say. Yes, this I don't think so. Whether you remember the disclosure angle, like these questions, if they give in the exam, no, I mean, correct. Now, generally, you will try to remember the accounting, right? What to debit, what to credit, or where to apply your calculator. These kind of things. It's very difficult at the student level. Maybe once you get into practice and once you start working on in-days projects, no, you will feel comfortable. But even though if you do 10 projects, no, there is no guarantee that you will get a restructuring related concept. Correct, no? So that will come little later. But yes, but one way it is good, one way it is very dangerous because of the MCQ, they can take any kind of thing into the account. Chalo, anyhow, which of the following is not required to be disclosed in relation to a provision? Yes, please come back. Answer me. Estimation of the financial effect, not required. Read the word which is not required. Estimation of financial effect, nature of obligation and expected timing and resulting outflow, indication of uncertainties about amount and timing of those outflows, expected reimbursement. Hmm. Which is not required to be disclosed. Array, you are already saying a provision. Correct, na? When you are already saying a provision hai to already have you recognized in the books of account? You have recognized. When you say it's a provision, it's already recognized. When I say recognized, isn't it some money, let's say some 100 crore rupees? Have you recorded already or not? You record it. That itself is the financial. So there is a financial effect of 100 crore rupees is what given. So again, estimate of its financial effect. Estimation of financial effect is recognized. It is already recognized. You don't need to disclose it. When you say 100 crore is what? Provision itself is an estimation. So it's already recognized. That is not required to be correct. Na? Which is not required. This is not required. Yeah, nature of obligation, expected timing of this resulting outflow. These are all normal things you are supposed to give. Indication of uncertainties, correct? Now, where this may undergo a change. Yeah, expected reimbursement, if any. Okay, expected reimbursement, if any. Correct? Yeah, this is also you are supposed to write it. Okay, is that clear, guys? Already recognized. Recognized, so separately financial effect, you don't need to give it. It's already there. Yeah, 16th bit. Which of the following is not required to be disclosed in relation to a contingent liability? Not required to be disclosed with respect contingent liability. Now the word is what? This is a contingent liability. Contingent liability ko financial effect, yes, you are supposed to give. You have to give. Correct. Na? If you say, what is that you should give? I'll tell you. We have seen some company, it's which way the audit is right now also going on. Yeah, so they have got a show cause notice order. This is not gone to a tribunal level or this is not gone to appellate tribunal or something, which is there at the what do you say, joint commissioner level it is there. Problem. 110 crore rupees show cause notice for demand. Why can't I demand it? Okay, it is not a demand notice exactly. Okay, if not, it will go to the court of law. That is secondary. Ignore that right now, not a matter as such. Okay, so now when I'm we have told that no, you make it as a contingent liability. Yeah. Management and KPMG is dealing with that matter, and everybody is confident that whatever their claim itself is wrong. I mean, it's okay, some mistakes do happen. That so some, I mean somehow, I mean, our opinion is that the department opinion is not correct. We are going to win for 100% guarantee or something like that. Since the case has come, okay, probable outflow of the money is not there, still it's a legal case. You should, I mean, it's going on. You show as a contingent liability. Now I have to tell, no, 100 crore rupees of money, correct na? Some I mean 11 million euros, something like that, we are supposed to mention that number. So financial effect is supposed to be given. Now tell me, my dear, next point. No, I mean, this is not the right one. I mean, out of B, C, D, anyone is not required. Think and answer me. Indication of uncertainties relating to this, yes, we will tell because it's already uncertain. Correct. No? Contingent event itself is uncertain. So that is not the that we disclose basically. Possibility of any reimbursement. Yes, we will disclose if any applicable. Amount or timing of an outflow. Amount of timing and outflow that I don't know only. No, this is contingent, right? Where do I get that information? Correct, na? So this is the correct answer, my dear. These three things are not. I mean, it's you cannot give for that. So that's why, I mean, sometimes it is very tricky to answer, but you should apply little bit of the presence of mind with respect to the question. At the same time, your overall knowledge should be present here. Then it works. Otherwise, it's very difficult. Right? Very good. 17. Again, Alu has come, but it is not the same question. That's why I have kept it. Yeah. Read the things, my dear. The 100 lakhs. If you delete it. Yeah. Alu Limited sold goods worth of INR 100 lakh for the year ended. Correct now, for the year ended March 2020. Warranty period for the goods as per the company policy is equal to 12 months from the date of sale. Fine, 1 year warranty. Estimated defect considering the past history of the company was 9%. Okay, overall 9% of the goods can come back. That means 9 lakh worth of sales can be affected. Average cost of warranty was 40% of the sale value. Okay, that is 3.6 lakh. 9 lakh is the total money will come back, into 40% is equal to 3.6 lakh. For the year ended 31st March 2020, correct. The company incurred cost of a cost of 1.5 lakh rupees. What will be the warranty cost that should be provided for the year 2020? Tell me, my dear. You already made a provision. You already incurred. See, incurred in the sense what? See, 1st April I sold some goods. The party has got till the next month March. The party has got a right to come back. Yeah, but 1st April when I sold, in the current year itself already 11 months are there. So it is already I spent 1.5 lakh rupees. Correct. So I spent some money already. So what is to be spent is nothing but totally expected is equal to 3.6. 3.6 minus 1.5, that is equal to 2.1, as you people rightly told. Perfect. All right. So 18th bit. Clear Limited has certain cases pending. Yeah, pending before the. Yeah, these are all pending before the various forums under different laws. The following table is a summary of such pending cases. Yes, particulars. 7 cases are there, 60% chance. For what? Yeah, estimated damage per case. 60% chance to lose. Cases before various, correct, na? 60% chances to win or lose. 7 cases lose chance is 60%. Okay. So estimated damage per case. But below what is he asking? Look at my dear. Okay. What will be the amount of contingent liability is asking? Yeah. Use your calculator and let me know. B. Okay. Priyadarshini says B. Yeah. 10.5 lakh rupees is the contingent liability is what answered by her. What about others? Yeah. B. Chetana. Okay. Fine. So must be B only. Yes. What is the chance? How did you get this B? Hmm? 60%. 7 cases. Correct, na? 7 cases to lose. 2 lakh is the damage. Yes. So that's why 2 lakh into 60% into 7. Perfect. So what is your answer? Six. I mean, 60% of 2 is equal to 1.2. 1.2 into 7. Correct, na? 1.2 into 7. That is 8.4. Keep it aside. Next, 3 cases 70 percentage. Okay, 3 means 2.1. 2.1 into 1 is equal to 2.1. Correct, na? Yeah, 2.1 plus 7 point, what is that number here? First one I forgot. Yeah, 7 into 0.6 into 2. That is equal to 8.4 plus 2.1. That is equal to 10.5. That's all. So that is how you got the contingent liability. Okay, right. Done. So 19th bit. Yeah, B Limited has purchased an equipment name is Shine as on 1st April 2021 for some special operations. Whatever. The useful life of the equipment is equal to 30 years. Due to some government norms, B Limited needs to incur 10 crore rupees for the restoration of the equipment at the end of the 30th year. Okay. The present value of the restoration expense is equal to 1 crore. He only gave. Nice person. What will be the impact on the P&L in respect of the provision for restoration expenses for the year ended 31st March 2022, assuming the discounting rate is equal to 8%? Tell me, my dear, what will happen? What will the impact on the P&L? See, first day when you make a provision for present value is equal to 1 crore. 1 crore you will make a, I mean, you will, what is this? Isn't it directly related to a specific equipment? PPE. Will you capitalize or will you charge it? Capitalize it. Correct, na? So 1 crore will be capitalized. Day one, you don't do anything. But at the end of the first year, what do you do? At the end of the first year, what are you supposed to do? 1 crore will be added to asset means, will you depreciate it or not? Correct, na? That impact will be there. He has not taken that. Okay, he has not taken, but you are supposed to, correct, na? You are supposed to take that also into P&L impact, you told. P&L impact of provision for restoration expenditure. This 1 crore will be depreciated over 30 years. So 1 crore divided by 30 also should be 1 crore divided by 30. That is a depreciation impact on the profit and loss. One number plus this 1 crore will be unwinded. Unwinded may 8 lakh rupees, 8% will come. That is also impact. Correct, na? That is also impact. Yes, interest cost of 8 lakh to correct. No impact on P&L, 100% wrong. No impact on P&L as it will be disclosed as a contingent liability. Pakka wrong. Okay, some betterment is equal to B. That's why B is correct. Otherwise, I hope you guys have understood this answer. Correct. Now, depreciation impact also is there as well as interest impact also is there because of this. Chalo. Next, what are all the ways for utilizing the provision in accordance with the 37? What are the ways utilizing the provision? It can be used for as an expenditures. It can be used for expenditure which the provision was originally recognized. It can be used when related to income is generated. Mhm. Yes, people are answering B. Yeah, guys. B. Chetan also says B. Mhm. Yeah, Nathanya also B. Perfect. Done, my dear. See, it can be used only for the expense for which the provision is originally made. Correct, na? It is not some reserve or I will reserve or something, I will do something. I made a provision for warranty means provision for correct. Na? Tomorrow when you spend for warranty, expense you spend, that time you will not transfer it to P&L. As on 31st March, I said warranty expense account debit to provision for warranty. Tomorrow when you spend expense, some warranty claim has come. That time we will not charge it to P&L. Provision for warranty account debit. Correct na? Whatever you have spent money or expenditure. Expenditure is going to be respective one, not to everything. Okay? Yes, as you people rightly said, perfect. So 21st. B Limited enters into a contract to supply 5,000 laptops for 50 lakh rupees. INR, you take it. Okay? Yeah, this is INR. Done. Yeah, so an increase in the cost of input has resulted into an increase in the cost of sales to 555 lakh rupees. See, so then what is this onerous contract? Isn't it going to be 5 lakh rupees loss? Exactly. The penalty for non-performing the contract is expected to be 3 lakh rupees. I think this is better. Correct, na? 3 lakh rupees you should make a provision, no? How much provision is required? Correct now for the financial statements of the company. Tell me, my dear, 55 of 50, obviously 3 lakh, whichever is lower. Na? If you continue the contract, you are going to get 5 lakh rupees of loss. If you discontinue the contract, then you will get a loss of 3 lakh rupees, whichever is lower. So obviously A is the correct. Na? Obviously A is the right answer. Done. Next question. XYZ Limited has received a legal notice on December 15th, 2013 by local environment protection agency something to fit a smoke detection. Yeah, smoke detector. Some same question was being discussed in the class also. Correct. Now, smoke detector in its factory on or before June 30th, 2014. Fine. And okay, before June 30th, 14 for the following year. Next, not a before, doesn't matter. The cost of fitting the smoke detectors in the factory is estimated to be 2.5 lakh. How should XYZ Limited treat it in the financial statements for the year ended 31st March December 2013? Okay, you are in December, you are supposed to fit it in June 2000, I mean 2014. Next year, you are supposed to do it. Tell you, my dear, do you make a provision for 2.5 lakh rupees? Why? I still have a time. Nobody has a right to come and ask me. Recognize a provision for 1,25,000 because he said I said half off. Okay, for the year ended December 30 because 50% of the time is up. This is nothing to do with 50% of the time. Correct now? Yeah, just a second. Some issue has come. Yeah, just a second. Are you able to see the screen? Now done. Right. So, not fitting the correct now. Right. So, make 125. Because XYZ Limited can avoid the future expenditure by charging the method of the operations and there is no present value for the future, no provision is required at the end of 31st. But as there is a possible obligation, this warrants the disclosure in the footnote of the as a contingent liability is trying to say. Okay, ignore this for the purpose of the financial statements for the year ended. Neither provision nor, I mean, nothing to be done debit. So answer me, my dear, which is the right one you will feel. C is See, why should I make a disclosure also? It's a possible obligation. Okay, as there is a possible obligation, this warrants disclosure in the footnote to the financial statement for the year ended 31st. Mm, possible obligation size correct. Yes, agree with you. See, yeah, because if I don't satisfy, that is depending upon the contingency, then I am supposed to take care of it. Okay, right. That's why it is right answer. Agreed. 23. A company recognized a provision for the retirement bonus in the total amount of 2 lakh rupees as of December 2030. The company expects to pay only 10,000 rupees in a year 2014, 15,000 in 15, 1 lakh 75,000 in 16. Ignore the discounting and advise how the provision should be recognized in the statement of financial position. Tell me. See, long term liability of 10,000 rupees, sorry, 1 lakh 90,000 rupees, 10,000 will be correct, which is supposed to be paid in the next year itself. Perfectly all right, my dear. Yes, it is supposed to be C only. Then that's all, my dear. E standard may I kept only 23 questions have come. Yeah, nothing is repeated, and I tried to maximum level. Okay, right. Uh, Fine, right. So the next standard, what I told you, next standard which we'll discuss tonight. Okay, I'll tell you the timing. I thought of something telling now. Not possible, I'll inform you. In days 20, we'll clear it. If the time permits, we'll get into 23 also. 23, I have got a lot of questions. And the next thing is 23 once gets over, 16 we'll try to clear it off. Right? Yes.